Hello there, welcome to the exclusive property market update for August 2019. My name is Luke Graham and I'm the head of research for Touchstone Property Intelligence. Firstly, today we'll look at property as an asset class and we'll look at how it fits into your investment portfolio and what you might be working with other investment professionals. Then we'll look at the 5 pillars of our property research, and this is what guides our property investment decision-making process, what helps us choose the properties that we're going to work with, what helps us reject ones that we're not going to work with. And then we'll do a market update. So we'll look at the main capital cities, look at who's performing well, who's not performing so well, and how things have been changing recently. We'll then look at the process of investing in property through us. And at the end, we'll have the opportunity for questions. So generally speaking, there are 2 major styles of asset classes, and they can fall into categories of both, or either financial assets or real assets. So some examples of financial assets you can see there: shares, very well known, owning a proportion of a company. Hopefully that proportion of the company's value increases over time, and you also receive dividends for the profits that the company makes. There are also derivatives, which are a more complex mathematical model. You have bonds, which is you lending money to either a government or a private organization, and also currency, so exchanging Australian dollar for US dollar or vice versa. Plenty of other currencies all around the world. Real assets, on the other hand, tend to be tangible. That is, that there's something that you can hold in your hand and realize its immediate value. So in the case of financial assets, you'll notice that this currency, as an example, if you'll have something on the computer screen, or if you're lucky, a note or coin in your hand. Whereas in the case of real assets, if you own something like machinery or collector items, they are a tangible asset you can hold. Now, real estate is obviously one of those, bricks and mortar, as it's colloquially referred to as. And under the category of real estate, there's a few different styles of real estate, and I've summarized just a few of them here. So commercial real estate, obviously, often where you're going to work. Industrial is where former generations were more likely to work. Retail, where you go shopping. Special purpose, good examples of that include aged care, pubs and clubs. And residential, which is what we're going to focus on today. Now, there are also 2 main types of property investors. The first being active property investor and the second being a passive property investor. Now, you probably think by the usual use of these words that the active property investor is better, but in this case, the active property investor tends to actually be the one who's facing quite a bit more risk. And a good example of an active property investor, as the image implies, is that active property investors tend to be on the high scale property developers or something like that, and on the lower scale, people like property speculators or those who buy and renovate and flip the property and things like that. Now, we're going to focus on the approach of passive property investment, and the benefit of passive property investment includes things like lower volatility. So the objective of a passive property investor is to buy and hold a property over a long period of time. That means you're less exposed to market risk. So fluctuations in median house prices, fluctuations in the level of supply and demand in a market, and those sorts of things. It's also much improved cash flow. So rather than buying a property and having to remove a tenant and having things going pretty crazy, the idea is that you buy a property with a strong enough rental yield to hold it over a long period of time, which means that there's a healthy amount of cash flow coming in and out of the asset, and less of a burden on yourself. Now, credit and leverage is also typically quite widely available, and that's because banks and other lenders are quite comfortable and familiar with residential real estate being held passively. There's $6.5 to $7 trillion worth of residential real estate in Australia, and the lenders are therefore very familiar with making finance available to buyers. Now, it's also far less time consuming. And this is the key one. So some people fancy themselves potential property developers into the future, and there's no harm in thinking about that. But the point that I make to people is that if you're going to move from passive property investment to active property investment, that typically also requires compromises elsewhere in your life, or a disproportionate level of them. So that might mean quitting your job and being a full-time property investor or something like that. And of course, the portfolio diversity. Since you have the access to leverage and credit, it means that as you build your property portfolio in a passive fashion, you're able to buy different property types. So it might be an apartment, a townhouse, a house. You can buy them in different areas. So Brisbane, Sydney, Melbourne, Perth, or potentially completely different markets. So the 5 pillars that drive our property research are illustrated in this graphic, and we're going to start first with demographics because I find it the most enjoyable. So the current population of Australia is estimated to be just under 25.5 million people. It surpassed 25 million last year, and very much on its way to 26 million. Now, quite interestingly, there were a couple of moments that really changed the landscape of the Australians' demography. And the first one you might be able to notice here on the population growth chart in the mid-1800s, when the gradient, that is the speed in which the population is growing, shifted. And that was a result of the gold rush, which very much put Melbourne on the map. Before that, you may, if you remember from primary school history or high school history, prior to the gold rush, Melbourne was really not much of a significant place at all. And Sydney would have been very much the candidate to be the capital of Australia. But by 1901, Melbourne had gone through half a century of economic expansion and therefore was very much a contender to be the capital of Australia. At one point, actually, Melbourne even became, they say, the wealthiest city in the world, surpassing the likes of London and New York. Now, at the end of World War II, just under a century later, the Australian approach to population growth shifted fundamentally, and that was due to 2 major things. So Australia realized that they couldn't defend themselves with such a small population, and therefore relaxed our extremely tight immigration laws. And also all the soldiers returning from war fueled what became known as the baby boom and the baby boomers, which was an entire generation. More than half of this population in Australia live in one of 4 cities, either Sydney, Melbourne, Brisbane, or Perth, our 4 major cities. Now, if you contrast this to similar countries like the United Kingdom, United States, and all that sort of thing, you see a much more evenly spread out population. So New York, as an example, is only home to about 3% of Americans, whereas our largest city, Sydney, is 21%. So a lot of major outcomes are driven by this, including the need for infrastructure, economic activity, and then the fact that more infrastructure and more economic activity are being concentrated in certain areas. We run into what's called a reinforcing feedback loop, which means that then attracts more people to the area. In particular, migrants are very attracted to our major cities, which then increases the level of need and demand for infrastructure, which then creates more economic activity, and the cycle goes on and on and on, which is what leads us into where we are now with such major cities in Australia. Another thing that we look at when we're considering demographics is how it's related or how it's correlated with other parts of our research. And so an example here on the graph to your right, which is probably a little bit complicated when first looking at it, is the relationship between the growth rate of the median house price in Sydney and interstate migration to Queensland. So I've summarised it on the left-hand side. If you can see these time blocks of 5 years, 1998 to 2003, the Sydney median house price increased by 83% and the migration rate to Queensland increased by 136%. Then when Sydney median house price did not do much other than just bounce around, 3% increase over 5 years, we saw a huge decrease in the rate of migration. Still a positive figure, but not as high of a figure as it was previously. Now, more recently, we have more up-to-date data, and we know that over the last few years, there's been a huge population boom via interstate migration in Queensland, particularly southeast Queensland. And we also do know that Sydney over that period of time went through another one of their price booms. And some of the examples in popular culture and the media of this being manifested is the analysis of competent and capable workers fleeing Sydney and heading up north to where there's better, arguably better weather. Now we'll look at economics next. Now, economics, one of the main drivers of economic activity, which I alluded to just earlier, is infrastructure. And some examples of infrastructure, I've taken a few from southeast Queensland here. The expansion of Brisbane Airport due next year, as well as the Queen's Wharf Development Casino Precinct in the middle of the city in 2022, which is expected to really fuel the Asian interest in southeast Queensland, as well as an example of a government infrastructure project, one of their largest in 2024. The Cross River Rail project is due, which is adding a couple more stations to the Brisbane rail network. Now, another thing that we consider when we're looking at economics is the proportion or the influence of certain industries on our economy and our GDP. So in 1959, we saw the peak of manufacturing in Australia when it represented directly 30% of gross domestic product in the country. And as you may have not seen over successive generations, that has declined to less than 6% of GDP today. Now, this has huge implications, not just on the jobs that people have and how they're able to pay for property, but also that what's called the highest and best use for real estate. So we were talking before about how there's residential, commercial, retail, industrial types of property. Now, with the decline of manufacturing and the increase in technology that's come around the same time, we've seen that the highest and best use of real estate, of industrial real estate in the middle of the city has transformed back to residential, which it was before the Industrial Revolution. Now, what that means is you'll see suburbs like Collingwood in Victoria or Waterloo in Sydney transforming into these thriving urban metropoli, which they certainly weren't only just a generation ago. Now we see with 30% of a GDP dedicated to manufacturing, the point that I make to people is whether they think a diverse economy is important on the basis of such huge, significant, singular drivers of an economy. And an example that I refer to in this regard is a tale of Gladstone Central mostly between 2004 and 2016, which is a time period you can see on the right-hand side of this chart. So the blue squiggly line, you can see that's the median sale price of homes in Gladstone Central each year. And the green bars is the number of sales made each year. So you can see that there was obviously a huge sales boom between 2010 and 2012. And you can see subsequently that the price of property in that area skyrocketed over that time. Now, interestingly, around about that period of time, I was photographed reading a magazine while on holiday. And you can see that I'm opened up to a property magazine with a major page spread on investments in Gladstone and other mining areas. The other one on the left is Port Hedland, talking about huge returns. And if you remember, back just less than a decade ago, you couldn't open up anything about real estate without looking at all the high returns that you were expected to achieve if only you were to invest in the mining towns. Now, Gladstone was actually quite unique when it came to mining towns, because in August 2011, which you can see in this image when I was reading this magazine, just after this event, the LNG gas pipeline construction was nearing completion. And so what was the case was that there was a huge employment boom in the area as a result of the need for workers to build this pipeline. But once the pipeline had actually been complete, the demand for work fell out. Now, that meant the demand for property also diminished, and then we saw the successive years of huge losses. Now, if you were to buy at the peak of this boom when advertising was at its most intense in 2011, you probably would have paid about $500,000 for a property in Gladstone. If that was the case, then by 2016, your asset would have halved in value, which would have been a financial nightmare. So since their economy was so dependent on the construction of the LNG gas pipeline, one thing that we really emphasize to our clients is to make sure that the economies that they're investing in are diverse, i.e., if something was to disappear economically, would it have a huge impact on that local area? And another example that I use in this regard is actually military bases. So Kevin Rudd, after in his second rallying term as Prime Minister, after deposing Julia Gillard, he was very vocal about moving the Navy base in Sydney up to Brisbane. Now, the smart thing that he did in this regard is that if that Navy base was to leave Sydney, it would not have impacted the Sydney economy. Most people would not have noticed it. It barely would have made the news. But it would have had a huge positive impact on Brisbane, a much smaller city. Now, if that base was to move to somewhere like Townsville or to Newcastle or another town, then it would have an even greater impact. Performance is the more mathematical side of our research. And one thing that we use to help us in analyzing the market then is the four major cycles the four major stages of the property cycle. So the best known is the boom, which is when prices are going crazy, people are climbing over each other to buy properties. The balance of supply and demand is in the favor of the side of supply, i.e. a seller is in a much better position than a buyer. Inevitably, after a boom, we see a correction. Hopefully nowhere near as bad as the one we just saw in Gladstone. But typically, as we've seen in Sydney recently, the property prices will cool off a little bit, which means that they'll come back to a more reasonable price. Then the longest period of the property cycle is a stagnation, which is when property prices aren't really doing anything. They're not really going up that much, not really going down that much. Quite a boring market. And then, of course, eventually we return to the upturn, which is when buyer activity starts to ramp back up again. Now, an example of what can happen when two markets are operating differently over this period of time can be seen on this graph. So the Sydney median house price between 2010 and 2017 had quite a powerful upsurge, whereas for Brisbane, it was kind of just puttering along, you can see there. Now, what that means is that the distance between those median house prices has grown significantly over that period of time, which creates upward pressure on Brisbane and downward pressure on Sydney. Now, we've actually seen just that over the last year or so, where Sydney median prices have gone through quite a correction. So if you bought at the peak, again, you would owe more on the property than you would have in equity. Whereas with Brisbane, we've seen really steady, strong price growth, or at least price stability in the face of major economic changes that we've had over the last few years, tightening and lending criteria, and the like, government intervention. Another mathematical or graphical factor that we look at is what's called the rental vacancy rate. So this is the percentage of properties that are vacant at any one time. Now, I've drawn a white line across these graphs to make them consistent, and they're at the 4% mark. Now, this is a huge lesson in what I call a huge lesson in public perception. And the reason behind this is that if you look at these two vacancy charts, you can see that they're attributed to postcodes. So you have postcode 3008 at the top and 3066 at the bottom. So we know they're both in Victoria. Let's have a bit more of a deeper look at these. In the top chart, you can see that vacancy rates were really high over this 5-year period of time, even hitting 12% 3 times. So that's massive. So in this environment, you're discounting your rent. You're trying to use any incentive possible to attract a tenant. The tenant's really in the driving seat here. You're at the will of your tenant, which is not a good position to be in, especially if they're not a good tenant, they're making a bit of a mess and those sorts of things. And so at the end of this period on the chart, you can see that the vacancy rate was, again, still at 6%, which is a huge number. Another thing I want you to notice about this chart is how long it takes after a boom in supply, how long, or oversupply, how long it takes for that oversupply to be absorbed. So at one point, it took a few years to get from those dizzying high vacancy rates just back down to 4% again. Contrast this with the graph below, and you see that only at one point in time did the vacancy rate even touch 4%, and it was for a very, very brief time. And for the rest of that period, it was in significant undersupply, which means the opposite, that tenants are all competing with each other over a few properties, which is a good position for the landlord. Now, interestingly, between these two postcodes, if we're to look at Melbourne CBD, trace it there with all the perfect little grid lines, as you may be familiar with, one of those postcodes was in Docklands and the other in Collingwood. Now, that's just 3.5 kilometres between each other. So when people talk about the Sydney market or the Brisbane market or the Perth market or the Melbourne market or whatever it happens to be, there needs to be a more nuanced approach if you're making investment decisions based on that. So it's all well and good to have said back in this time that the Melbourne rental market was oversupplied, but that was specifically in Docklands and similar areas. Meanwhile, just a walk away, all things considered, there was significant undersupply, huge rental growth, and all those sorts of things. So it's important for us not just to look at the high city level and kind of make a decision that we're going to work with the city, but to look a little bit more zoomed in to determine what parts of cities are effective, what parts of cities look like good investments, what ones are performing quite poorly, and how timing applies to those. So you may have noticed that we haven't really even looked at property yet. And where that comes in is with product, the final P. So some of the things that we look at when we're considering a property itself, particularly if it's a larger development, so something like townhouses or an apartment, is internal amenity. And so that could include things like a gym, a pool. I like using pools as an example because if you contrast Brisbane with Melbourne, or if you go even further, Cairns with Hobart, the utility of a pool is going to be substantially different, especially if it's outside and it isn't heated. So obviously in northern Queensland, it's going to be a lot longer of the year when you're able to use something like a pool, which means that its perceived value is arguably much higher. Now, relevance to demand is another quite important one that I like to talk about when we're talking about product. And a good example of that is comparing the types of property that you're going to see if you're a Sydney sider between somewhere like Point Piper and then somewhere like the Greater Western Sydney. Now, it's very important to match the property type and the standard of finishes and fixtures and the size of the property and all those sorts of things with the local demographic and what they expect from that area. Now, if you look at a property in King's Cross or somewhere around Darlinghurst, famously some of the smallest apartments in the country, people accept that because they're living in that area to be close to certain amenities rather than to have open space. Whereas if people are moving into Kings Park or Blacktown or something like that, usually the expectation for property space is going to be much higher. Sorry, we also have regulation, which I haven't touched on yet. I think that's the final pillar in this list. And a good example of regulation has really come to the fore over the last few months, the cash rate being dropped by the Reserve Bank of Australia twice over a 2-month period to now sit at an all-time record low of 1%. So you should be talking to your lender if they haven't passed that on to you. Maybe have a chat with your mortgage broker and see what they can do there. I'm not an expert in that field, so don't take my advice. Some other examples of regulation that's impacted the property market recently, the federal budget. So we know during the election campaign, Labor campaigning to abolish negative gearing benefits, and that was that evidently had quite a significant influence on even just the sentiment of the property market. We also have the state budget impacts things like stamp duty, which is the biggest cost of investing in property at the beginning. We have non-government organizations and industry watchdogs, so people that regulate my behavior, people that regulate financial planning, mortgage broking, and those sorts of things. And of course, planning law at the local level, which influences the types of properties that are able to be built on an area. If you own a house and all of a sudden in 20 or 30 years' time, a property developer wants to buy it to build a block of apartments, that has quite an impact on you. So now time for the market update. We'll start with Sydney, Australia's largest city. We've seen the median house price there continually decrease, although it's now decreasing at a rate lower than it was in the past, which means, in other words, that, and many economists are saying this as well, that it seems to be the case that the worst has, that we've been through the worst. The median house price is now back to where it was in March of 2016. And so this is again where I emphasize the importance of not investing in property in a boom. So if you bought in Sydney anytime after March 2016, you're now what's called in a negative equity position. Melbourne, on the other hand, since it didn't go as crazy in the last property cycle, it's not in as negative as a position during the correction. So it is a buyer's market for both apartments and houses, meaning that buyers do have a stronger negotiation position. There is a big disparity, as we saw between Sydney and Brisbane house prices. There's also a disparity between Melbourne houses and Melbourne apartments, which has the same tension, or creates the same level of tension between those prices, which could be a favorable thing for apartments when you consider. Price growth slowed over 2018, started correcting this year, but it was the second highest growth city back in 2017. Median house price much more affordable than Sydney means the risk in that market is still much lower. Brisbane, on the other hand, as we've mentioned, has been somewhat stagnant for an extended period of time, really ever since the Brisbane floods in 2011, which means that the affordability is really, really strong there. And Brisbane tends to be the favorite for a lot of market commentators, not just ourselves. So we like the proposition of houses and townhouses in Brisbane. It went through a phase recently of a high level of supply of apartments, but that's really dried up over the last couple of years. Townhouses being developed in the inner rings of Brisbane tend to have very strong potential as the city becomes more urban. Now, what that means is that Brisbane, historically, you could argue, has been somewhat of a quasi-town, country town, whereas the diversification of its economy, huge level of demand for services, and the professional services that provides as well, has made Brisbane very much a global city. And so when you look at global city rankings and all those sorts of things, you see Brisbane skyrocketing each time they do the new rankings. Perth, on the other hand, I always have a bit of a challenge with Perth because they're so heavily dependent on the mining sector. And again, if I referred back to the statements I made about about markets that focus too heavily on one industry or another, it's something that I've always been a bit apprehensive with Perth. In saying that, as we know, Perth has gone through periods in the last couple of decades of quite strong price performance, but they've been in an extended period of stagnation and even correction ever since the mining boom dried up quite a few years ago. So to summarize all the cities, because obviously we can't go through all of them, Hobart's currently the best performing capital city in Australia, growing at 4.6% per annum in the last update, whereas the worst performing city is Sydney, which declined by 10.3% over 12 months. So to summarize, the process of investing with Touchstone Property Intelligence, firstly, obviously today you're doing the online webinar and I hope you've been enjoying it. When appropriate, you'll then move on to having a personal strategy meeting, which is when you sit with one of my teammates and actually go over your personal circumstances. So you may have noticed this is all general in nature. This has nothing to do with your own personal situation. All of this should be accompanied by personal one-to-one advice that's tailored to your own personal needs. And of course, after that, usually if you're going to move ahead with investing in a property, you will then reserve one, which usually means taking it off the market, or at least putting a brief hold on it. Within a couple of days of doing that, you'll need to submit what's called an expression of interest form, which is usually accompanied by a deposit. And within 10 business days, we try to have those contracts exchanged, this contract of sale exchanged. So when you submit your expression of interest, typically the contract of sale will be sent to your solicitor or conveyancer. And if you don't have one, we can help you with that. And they'll go through the process of negotiating with the vendor. A lot of that work that we've already done beforehand anyway. And after contracts have exchanged, depending on the condition of that contract and whether the property has been built or whether it's under construction, you will then settle, which is when the property becomes your responsibility. Now, of course, an ongoing thing that we do, including these webinars, is offering you an ongoing service. So our relationship is maintained throughout, not just when you're thinking about buying an investment property. So you're more than welcome to visit these property market updates. Also, what I do from time to time is review clients' portfolios, talk to them about the performance of their asset, the performance of their particular market, and those sorts of things. So that service is also available to you. So in review, I think both risk and reward, we saw, although there are upsides to certain markets, you've also got to consider what the potential downsides are. A good example of that is buying in Sydney in the peak of the boom. Remember that property does work in cycles, so it's not just all about booms and all about corrections. There's also the stagnations and upturns. And remember to maintain that long-term investment mindset. So you've seen quite a few graphs today, and you'll see that people who are able to hold properties over a couple of decades rather than just a couple of years end up with much better performing assets. And so now I'll open up to questions. So you'll notice that there's a chat box if you want to open up a chat box, have any questions. If you're heading out now, it was lovely to have you. Look forward to catching up with you soon. If not, look forward to seeing your questions. I'm going to stop the recording at this point as well, so your questions won't be in the recording. Best of luck, and I'll talk to you soon.